Um, Imagine getting a phone call tomorrow. An estate attorney on the line, and they tell you that you are about to inherit a massive, completely life-changing sum of money.
Right, the dream scenario.
Exactly. The dream. Your mind immediately starts racing. I mean, you're mentally paying off your mortgage, you're quitting your job on the spot, funding your kids' college accounts. But then, well, reality actually sets in.
Yeah, the tax man always comes knocking.
Yeah, the IRS takes a cut. And then you find out about hidden debts. You realize your parents' end-of-life medical care, drain the accounts by hundreds of thousands of dollars. Suddenly, that life-changing windfall looks like, I don't know, pennies on the dollar.
It's brutal, but that gap, that huge space between the fantasy of inheriting wealth and the actual messy friction of reality, that is exactly what we are unpacking today. It's honestly the single biggest financial illusion of our time.
Welcome to this deep dive, brought to you by the team at 2 and Compound. If you're sitting there wondering how the shifting sands of generational wealth are going to impact your family, your small business, or just like the cost of a starter home in your neighborhood, you're absolutely in the right place.
Because we are cutting through all the casual influencer hype today and looking directly at the actual data.
Right. The mission for today is to figure out what the great wealth transfer actually looks like on the ground.
Yeah.
Especially now that the brand new One Big Beautiful Bill Act, the OBBBA, has, well, completely rewritten the tax code as of January 1st, 2026.
And we spent the last few weeks digging through a mountain of source material to get you these answers. I mean, we're pulling data from Cerulli Associates, Vanguard, Visa Business, and Economic Insights, plus legal briefings from firms like Frankfurt, Kernick, Klein, and Sels.
It's a lot to process.
It is, yeah. But our goal is to synthesize all of this so you can actually make sense of what's happening, because what's happening right now is huge.
It really is. Whether you are an heir waiting on a transfer, an entrepreneur trying to protect a successful exit, or just, a regular market observer wondering why the housing market is acting so irrationally, this directly affects the economy you live in. So let's just start with the elephant in the room.
The headline number.
The massive headline number.
Yeah.
Cerulli Associates is projecting that a staggering $124 trillion will transfer between generations by the year 2048. And to put a finer point on it, they estimate $105 trillion is going to heirs, and about $18 trillion is earmarked for philanthropy.
Which is just, it's hard to even wrap your head around.
$124 trillion. That number is so large it almost feels fictional. Like, how did we even arrive at a figure that big?
Well, it feels fictional, but it's the result of some very real, very unique historical math. I mean, we are looking at a confluence of extreme asset appreciation and just simple demographic aging.
Right, because of the baby boomers.
Exactly. Since the pandemic in 2020, we've seen equities jump by about 27%, and real estate values have surged an unbelievable 39%. So when you combine that unprecedented, almost violent growth in asset prices with the fact that households aged 60 and older now control roughly 61% of all wealth in the U.S., the compounding is staggering.
So they basically rode the greatest economic wave in human history.
They absolutely did. They accumulated massive home equity over decades and stayed invested through a historic, prolonged bull market.
So they're basically sitting on this massive pile of chips at the casino, and the assumption is they're just going to slide that entire pile across the table to Gen X and Millennials. It sounds like everyone is about to hit the jackpot.
Yeah, it really does sound that way until you read the fine print.
Right. And this is where the Visa Business and Economic Insights report threw just a massive bucket of cold water on that whole narrative. They look at the exact same phenomenon and calculated the actual net capital passing to Gen X and Millennials over the next 20 years. And their number wasn't $124 trillion.
No, it was not.
It was a much more sobering $36 trillion.
Yeah, the Visa report is essential reading because it completely grounds the conversation in reality. What Visa did was apply the friction of everyday life to that original Cerulli projection. To get from $124 trillion all the way down to $36 trillion, they had to subtract the massive liabilities that older generations are currently carrying.
Wait, what kind of liabilities are we talking about exactly?
A huge piece of it is late-life health care. I mean, end-of-life care, memory care facilities, in-home nursing. These are exorbitant expenses. They can easily drain a seven-figure portfolio in a matter of a few years.
Oh, wow. Yeah, that's incredibly expensive.
It is. And Visa also accounted for general retirement spending, the philanthropic bequests we mentioned, basic taxes and wealth management fees. But honestly, the biggest thing Visa did, the crucial adjustment, was filtering out the top 1% of ultra-wealthy outlier households. They wanted to see what this transfer looks like for the broader population, not just the billionaires.
Okay, so filtering out the Jeff Bezos and Elon Musk tier estates of the world.
Yeah.
Makes sense. And when you do all that math, the Visa report suggests that this wealth transfer equates to roughly $515,000 per inheriting household.
Which is still a lot of money, but it's not quit your job and buy an island money.
Right, exactly. To me, looking at these two numbers is almost like reading a corporate earnings report. The Cerulli $124 trillion headline, that's the company's gross revenue. It looks incredible on a press release, gets everyone hyped up. But the Visa $36 trillion figure,
That's the net profit.
that's the net profit. That is the actual cash left in the register after paying the operating expenses of aging, healthcare, and debt. And frankly, it's the only number you, as an everyday heir, are actually going to see.
You're spot on. And even that $515,000 average can be, well, slightly misleading because of how concentrated the remaining wealth is. The most defining feature of this entire event isn't the total volume of money, it's the concentration. The data shows that the top 2% of households are projected to account for 50% of the total transfer volume. Wait. Half of the entire wealth transfer is happening within just 2% of families.
That's right. That is $62 trillion moving back and forth between a very small, highly exclusive group of ultra-high net worth families.
That is insane.
For them, this transfer is a monumental logistical event. It requires armies of lawyers, accountants, and complex trust structures. But for the vast majority of the population, like the bottom 90%, the narrative of a life-changing windfall just isn't supported by the math at all.
And the math actually gets a lot darker at the other end of the spectrum, doesn't it? I was looking at a study from the University of Michigan that was cited in our sources, and it completely shattered my assumptions.
Oh, the inheritance gap study.
Yeah. They analyzed individuals approaching retirement between 1992 and 2016, and they found this massive inheritance gap. For the bottom 90% of individuals in that demographic, their overall net wealth actually decreased during that period.
Which is an incredibly sobering statistic when you consider they lived through the biggest period of asset growth in the nation's history. Seriously, how does that even happen? How do you lose wealth during the biggest bull market ever?
Debt outran the asset growth. It's really that simple. Many middle-class baby boomers took on significant mortgage debt, they refinanced multiple times, or they pulled out home equity loans to fund lifestyle expenses or their kids' college educations.
So they basically use their houses as ATMs.
Exactly. So yes, their home value skyrocketed on Zillow, but the actual equity they own outright, it's minimal or in some cases completely non-existent because of the debt they carry against the property. Teresa Ghilarducci, she's a labor economist cited in the CFA Institute brief, she pointed out that the median inheritance for the bottom 90% of Americans is effectively zero.
Zero, wow.
And in some cases, less than zero. We are actually seeing a significant minority of adult children who are transferring wealth upward. They are financially supporting their aging parents because the parents outlived their retirement savings.
Okay, I have to jump in here and push back on the framing a little bit.
Sure, go ahead.
Because if we're saying the bottom 90% is getting practically zero and the top 2% are just, playing financial chess with $62 trillion in offshore trusts, it makes it sound like this whole great wealth transfer narrative is just a myth. Like it means absolutely nothing for the middle class. But if I look closely at the Visa report, they make a really strong case that this money is actively distorting the markets that everyday people have to live in.
Oh, it absolutely matters to the middle class, just not in the form of a direct deposit to their checking accounts.
Right.
Even if the wealth is hyper-concentrated, the sheer velocity and volume of capital moving through the system has powerful macroeconomic ripple effects. Take consumer spending. Visa estimates that about $8 trillion of this transferred wealth is going to be injected directly into the consumer economy. But, without a doubt, the most visible distortion is the housing market.
This is what everyone is feeling right now, isn't it?
Yeah. We are seeing inherited wealth or early cash gifts from living parents being deployed to completely bypass high interest rates. I mean, if you have a wealthy parent who can front you a massive cash down payment or just buy the house outright, mortgage rates literally don't matter to you.
Because you're not getting a mortgage anyway.
Right. And this dynamic keeps housing prices artificially elevated. It effectively locks out the middle-class buyer who relies on a traditional W-2 income and a standard 20% down payment without any parental help.
So you're essentially forced to bid against someone who has a $500,000 parental safety net. That is incredibly frustrating.
Precisely. And it's reshaping travel and leisure, too. We're seeing a massive spike in what they call skip generation vacations.
What is that?
It's where grandparents are funding luxury travel for their grandchildren, completely bypassing the parents' bank accounts. So while the average person might not be receiving a $500,000 inheritance check, they're living in an economy where the cost of housing, travel, and services is being inflated by peers who did get that check.
So the ripple effects hit everyone. That makes a lot of sense. And if this highly concentrated wealth is distorting the economy that much, we really need to understand the mechanics of how it's moving. Because it's not just cash and envelopes, right? It's highly structured.
And very highly structured.
And that brings us to the brand new rule book governing this entire multi-trillion-dollar game. The One Big Beautiful Bill Act, or OBBBA, which just took effect January 1st, 2026.
The OBBBA is basically the regulatory catalyst of the decade. It is fundamentally reshaping the wealth management industry as we speak. But to understand why it's such a big deal, you really need to understand the panic that preceded it.
The Sunset Clause panic.
Exactly. Back in 2017, the Tax Cuts and Jobs Act, the TCJA, temporarily doubled the federal estate and gift tax exemptions. Under those old rules, a wealthy individual could transfer roughly $14 million completely tax-free. But there was a catch.
Right. That generous provision was scheduled to sunset or expire at the end of 2025.
Yes. If Congress did nothing, the exemption was going to get chopped in half, dropping back down to around $7 million. This created absolute hysteria in the wealth management world over the last few years. You had families frantically rushing to set up trusts and gift assets before the deadline hit, absolutely terrified they were going to lose out on millions in tax-free transfers.
It was like a massive game of musical chairs, and everyone was terrified the music was going to stop on New Year's Eve 2025.
Right.
But then the OBBBA gets signed into law on July 4, 2025, and it completely removed that ticking clock.
Permanence is the key word here. The new law permanently extended those exemptions. So as of January 1st, 2026, the federal estate, gift, and generation skipping transfer tax exemption is permanently cemented at $15 million per individual.
Okay, and if you're married, you get to combine those, right?
Yes. Utilizing proper portability rules between spouses, a married couple can now transfer a combined $30 million completely free of federal transfer taxes. Furthermore, starting in 2027, those baseline numbers will be indexed for inflation, so they will actually continue to climb. Anything above that $30 million threshold is subject to a flat 40% top federal tax rate.
Okay, so the panic of the ticking clock is gone. People can breathe. But the OBBBA didn't just extend the estate tax limits. It introduced a whole suite of other tax changes that really alter the math for high net worth planning. Let's talk about the SALT deduction first, the state and local tax deduction.
Under the old laws, the SALT deduction was famously capped at $10,000, which, heavily penalized high earners in high-tax states like New York or California.
Right. People were very upset about that.
Extremely. Well, the OBBBA increased that cap to $40,000 for joint filers. However, there's a nuance. That $40,000 deduction begins to phase down for high earners making between $500,000 and $600,000 a year. So it provides relief for the upper middle class, but it still pinches the ultra-high earners.
Got it. And they also tweaked how philanthropy works. I saw in the briefings there's this new 0.5% AGI floor on charitable deductions. What does that mean in plain English for someone trying to write a check to a charity?
Well, AGI stands for adjusted gross income. The new rule means you can only deduct charitable contributions to the extent they exceed 0.5% of your AGI. So let's say your adjusted gross income is $1 million. 0.5% is $5,000.
Okay.
You would have to donate more than $5,000 to charity before you could start deducting a single dollar from your taxes. It essentially eliminates the tax benefit of small, casual, charitable giving for high earners. It pushes them to make larger, more consolidated donations.
Oh, that's interesting. Now, the one that really caught my eye in the legal briefings was the change to QSBS, qualified small business stock. If you are an entrepreneur listening to this deep dive or you work at a startup and hold equity, this is massive.
The QSBS changes are arguably the most aggressive wealth creation tools in the new law. Under the old rules, if you held qualified startup stock for 5 years, you could exclude a massive portion of the capital gains when you sold the company. The OBBBA made this even more attractive by creating a tiered exclusion that kicks in earlier.
So you don't have to wait the full 5 years anymore.
Exactly. The new tiered system starts at a 3-year holding period. If you hold the stock for 3 years and sell, you can exclude 50% of the gain from taxes. If you hold it for 4 years, you get a 75% exclusion. And if you make it to the 5-year mark, you get a 100% exclusion on those gains.
Wait, which is incredible. You can literally build a company, sell it, and pay zero federal capital gains tax on the profit. And they raised the ceiling on how much you can exclude, right?
They did. They raised the absolute limit on excludable gains from $10 million up to $15 million. This is a massive legislative incentive for startup investment. It's designed to funnel capital into early-stage entrepreneurship by providing a virtually impenetrable tax shelter for successful business exits.
Okay, let's pause and look at the big picture here, because there's something that feels totally contradictory to me.
What's that?
Well, if a married couple can now pass on $30 million completely free of federal taxes, that exempts, what, 99.8% of the American population from ever worrying about the federal estate tax?
Oh, easily. Very, very few households have a net worth exceeding $30 million.
Right. So if the threat of the federal tax man is essentially gone for almost everyone except the ultra-wealthy, why are wealth advisors still pushing these incredibly complex trust structures? Like, if I have a net worth of $8 million, which is a lot of money, but well under the $30 million limit, and I go to a wealth manager, they immediately start throwing alphabet soup at me.
The acronyms.
Yes. They're pitching SLATs, GRATs, ILITs, FLLCs. If I don't have a federal tax problem, why on earth do I need all these complicated trusts?
It's probably one of the most common misconceptions out there. People have been conditioned for decades to view trusts purely as tax-dodging instruments. But with the federal tax threat neutralized for estates under $30 million, the entire focus of wealth management shifts. It pivots away from avoiding the IRS and moves toward two different goals: mitigating state-level taxes, and more importantly, asset protection and family governance.
Let's break that down, because I think a lot of people get lost in the jargon. Let's tackle the state-level tax issue first.
Sure. The $30 million exemption is only for federal taxes. Many individual states have their own estate taxes, and their thresholds are often far, far lower. Depending on where you live, your estate might be taxed by the state on anything over $3 million, or maybe $5 million. So trusts are still heavily utilized to navigate those state-level burdens.
Okay, that makes sense. But what about the asset protection piece? Let's actually go through this alphabet soup, because it's confusing. Let's start with a spousal lifetime access trust. How does that work, and why would someone under $30 million use it?
Let's use a hypothetical family to make it clear. Imagine a husband and wife who have built a very successful medical practice and accumulated about $15 million in assets.
Okay, so they don't have a federal estate tax problem.
Correct. But physicians are highly prone to malpractice lawsuits. If the husband sets up a SLAT, he can transfer, say, $5 million of his assets into this trust for the benefit of his wife. By doing so, he legally removes those assets from his own estate.
So if he gets sued?
If he gets sued personally, creditors generally cannot touch the money in the SLAT because technically he doesn't own it anymore, the trust does. But because his wife is the beneficiary, the family still has indirect access to the funds if they need them to maintain their lifestyle. It basically builds a legal fortress around a portion of their wealth.
Got it. It's a firewall against lawsuits. Now, what about a GRAT? A grantor retained annuity trust. I hear this one tossed around a lot by tech founders.
A GRAT is brilliant for assets that you expect to grow explosively in value. Say you own pre-IPO stock in a tech company that is currently worth $2 million, but you think it will be worth $10 million in 5 years. You place that $2 million stock into a GREET. The trust is designed to pay you back an annuity, like a fixed yearly payment, equal to the initial $2 million value plus a small IRS-mandated interest rate.
So you're essentially just paying yourself back the original value.
Yes, but here's the magic. If the stock explodes in value and grows to $10 million, all of that excess growth, the $8 million of upside passes to your children or heirs completely tax-free at the end of the trust term. You successfully shifted the future growth of the asset out of your estate without using up any of your lifetime gift exemption.
And what if the stock tanks?
If the stock tanks and loses value, the trust just collapses back to you with no penalty. It's essentially a heads I win, tails we tie scenario.
That is fascinating. You're freezing the value of the asset today and giving away tomorrow's growth for free. Okay, what about an ILIT? An irrevocable life insurance trust?
An ILIT solves a very specific liquidity problem. Let's say a family has a massive real estate portfolio. They're worth $40 million, mostly in apartment buildings. When the parents die, they are over the $30 million federal limit, so they are going to owe a massive 40% estate tax bill on that excess $10 million.
That's a $4 million tax bill due in cash, but their money is all tied up in bricks and mortar.
Exactly. The heirs would be forced to fire sell the apartment buildings just to pay the IRS. To prevent this, the parents set up an ILIT. The trust purchases a massive life insurance policy on the parents. When they die, the insurance pays out a multi-million-dollar death benefit directly into the trust.
I see.
Because the trust owns the policy, not the parents, the death benefit isn't subject to estate taxes. The trust then uses that tax-free cash to pay the IRS, allowing the family to keep the real estate empire completely intact.
So it's literally just a bucket of tax-free cash waiting to pay the eventual tax bill.
That's smart.
And finally, the FLLC, the Family Limited Liability Company.
This one is purely about family governance and control. Imagine parents who own a highly profitable chain of car dealerships. They want to start transferring the wealth to their 3 kids, but the kids are in their 20s and don't know the first thing about running a business. The parents can create an FLLC and put the dealerships inside it. They then create 2 classes of shares: voting shares, which control all the business decisions, and non-voting shares, which just hold economic value.
Let me guess. The parents keep the voting shares and give the non-voting shares to the kids.
You got it. The parents can slowly gift 99% of the economic value of the company to their children, moving that massive wealth out of their estate. But because the parents retain the 1% of voting shares, they maintain absolute dictatorial control over the business. They decide if the company is sold, they decide if distributions are made, they get to give away the wealth without giving away the steering wheel.
Okay, that completely clarifies it. You aren't just hiding money from the government, you are protecting it from creditors, divorces, and frankly, from the financial immaturity of your own heirs. And this leads perfectly into a major behavioral shift we are seeing in the data. Because of the certainty provided by the permanent OBBBA limits, and because boomers are living much longer, the whole strategy of passing down wealth has changed. It's no longer this dramatic post-mortem event where everyone gathers in a mahogany office for the reading of a will. It has become a real-time, active, daily process. Let's talk about the rise of giving while living.
The data on this trend is really eye-opening. According to a comprehensive survey by RBC Wealth Management, 66% of boomers explicitly state they want to enjoy their wealth or actively watch their heirs enjoy it while they are still alive.
Wow, 66%.
Yeah. They looked at their portfolios, realized they have more than they could ever spend, and decided they don't want to hoard it until they're 95 years old. They want to actively subsidize their children and grandchildren today.
And the tax code practically begs them to do this. In 2026, the annual gift exclusion sits at $19,000 per recipient. If you are a married couple, you can combine that to give $38,000 to any individual every single year, completely tax-free. And here's the kicker. That $38,000 doesn't even count against your $30 million lifetime exemption.
It's a loophole you can drive a truck through.
Right. You can give $38,000 to your son, $38,000 to your daughter-in-law, $38,000 to each of your 4 grandchildren every year without touching your lifetime limit.
It's a massive pipeline for wealth transfer. And on top of that, there are unlimited exemptions for direct payments regarding health and education. If a grandparent writes a $50,000 check directly to a university to cover their grandchild's tuition, or, writes the $100,000 check directly to a hospital to cover a family member's surgery, it is totally exempt from gift taxes. It doesn't use the annual exclusion, and it doesn't touch the lifetime exemption.
The economic footprint of this giving while living trend is wild when you dig into the generational data. I mean, we have Generation X, who are theoretically slated to inherit about $39 trillion. But right now, Gen X is trapped in what sociologists call the sandwich years.
Squeezed from both sides.
Exactly. They're in their 40s and 50s, financially burdened by raising their own teenage kids or paying college tuition, while simultaneously managing the emotional and financial care of their aging boomer parents.
Which is why lifetime gifts to Gen X often take the form of practical relief. It's parents stepping in to pay for the grandchildren's private school or covering the cost of an in-home nurse, basically freeing up Gen X's cash flow.
Then you have the Millennials, slated for $46 trillion. This is where the housing distortion we talked about earlier really crystallizes. The data shows 25% of millennial homeowners receive parental help for their down payments.
That's a huge number.
It is. And a staggering 69% of millennials surveyed said an inheritance or direct family financial support is absolutely critical for them to ever buy a home. They aren't hoping for an inheritance. They're actively relying on it as a core component of their financial plan.
Hmm.
And millennials are also driving a shift in how wealth is invested. They are showing a massive preference for alternative investments, private equity, and ESG, environmental, social, and governance impact investing. They want the money to align with their values.
And finally, you have Gen Z, who might see around $15 trillion down the line. Interestingly, the data suggests Gen Z is highly focused on financial basics, avoiding debt and entrepreneurship. They watch the economic chaos of the last 20 years, and they just want control.
It seems like giving while living is the perfect mechanism to bridge these different generational priorities. I look at it like giving your kid a learner's permit for wealth.
I like that analogy.
Because if you just leave them $10 million in a will, you are handing them the keys to a Ferrari after you're dead and hoping they know how to drive.
Mm-hmm.
But with lifetime gifting, you hand them the keys to a small portion of the portfolio, but you, as the parent, are still sitting in the passenger seat.
It acts as a financial test run. When you pass down $50,000 or $100,000 while you are alive, you get to observe how your child stewards that capital. Do they invest it wisely? Do they use it to start a sustainable business or buy a practical home? Or do they immediately inflate their lifestyle, buy a luxury car, and blow it in Vegas?
Right. If they merge onto the highway going 20 miles an hour, you can reach over and hit the brakes.
Precisely. If they show poor judgment, you can adjust your ultimate estate plan. You can hire an attorney to construct more rigid trusts, like we talked about earlier, with tighter guardrails before you pass away. It allows the wealth creator to mentor their heirs, instill their financial values, and course correct, rather than just crossing their fingers and hoping for the best post-mortem.
But this constant, real-time subsidy kind of alters the very definition of the word inheritance, doesn't it? Historically, an inheritance was a lump sum you received when you were 55 or 60 years old. You were already established in your career, your house was mostly paid off, and the inheritance was just the cherry on top for your retirement.
Right, it was a bonus.
Exactly. But today, because the economic pressures on younger people, and because boomers are living into their late 80s and 90s, inheritance is transforming into a lifelong drip feed of capital. It's continuous financial support that dictates a millennial's lifestyle choices in real time.
It fundamentally changes the timeline of wealth accumulation. But, and this is a very big but, this live-action wealth transfer hides a massive, easily overlooked pitfall. It is a pitfall that can cost families literally millions of dollars in unnecessary taxes if they aren't careful, and it's something every single family needs to understand before they start transferring assets.
Okay, you are talking about the step-up in basis versus lifetime gifting dilemma. This is arguably the trickiest part of the tax code we looked at. If you are listening to this and you own an asset that has gone up in value, a house, a stock portfolio, a piece of art, you need to pay close attention to this.
It is the most critical mathematical decision wealth advisors navigate with their clients today. It all comes down to the tax consequences of how and when an asset changes hands. There is a fundamental structural difference in the tax code between gifting an appreciating asset while you are alive versus passing it through your estate when you die.
Right. Let's break down the mechanics of this. If a parent gifts an appreciating asset to their child while they're still alive, the child inherits the parent's original cost basis.
Yes, and that is a massive liability. Let's walk through a detailed, tangible example so the mechanics are perfectly clear. Suppose a parent bought a beachfront property 30 years ago for $100,000. Over the decades, the area booms, and today that property is appraised at $2 million. The parent decides they want to give while living, so they legally gift the deed of the house to their daughter tomorrow.
Okay, the daughter now owns a $2 million house. Great for her.
Correct. But for tax purposes, the daughter's cost basis, the number the IRS uses to calculate her profit, is still the parent's original $100,000. If the daughter turns around and decides to sell the house the very next day for its $2 million market value, she has realized a $1.9 million profit in the eyes of the IRS.
Oh, no.
Yeah, she will owe capital gains taxes on that entire $1.9 million of growth. Depending on state and federal rates, that could easily be a tax bill of $400,000 or more, simply because the asset was transferred during the parent's lifetime.
That is a brutal tax hit. But what happens if they wait? What happens if the parent just keeps the house in their name until they pass away?
If the parent retains ownership of the house until they die, the asset is included in their taxable estate. Under current law, when the daughter inherits the property through the estate, the asset receives what is called a step-up in basis. The cost basis is automatically adjusted by the IRS to the current fair market value on the date of the parent's death.
So the daughter's basis magically becomes $2 million.
Exactly. The IRS basically wipes the slate clean on all that historical growth. If the daughter inherits the house and sells it the next day for $2 million, her basis is $2 million, and her sale price is $2 million. Her taxable gain is exactly zero. She owes absolutely nothing in capital gains tax.
So to use an analogy, gifting a highly appreciated asset while you are alive is like handing your kid a hot potato with a massive ticking tax bill baked inside. But passing it at death is like wiping the chalkboard completely clean. The IRS just forgets that the first 30 years of growth ever happened.
That's a great way to look at it.
But this creates an agonizing dilemma for advisors and families. Do you gift the asset now to lock in the permanent $30 million OBBBA exemption and get future growth out of your estate? Or you hold on to the hot potato until you die to get that sweet step up in basis?
It requires meticulous mathematical modeling. There is no one-size-fits-all answer. For the vast majority of families' estates that are comfortably under the $30 million OBBA exemption limit, holding on to highly appreciated assets until death is almost always the mathematically optimal strategy. Because the estate is under $30 million, they aren't going to face the 40% federal estate tax anyway. So there is no reason to gift the asset early and burden the kids with capital gains taxes. You hold it, let them inherit it, and they get the massive benefit of the step-up in basis.
But what if you are the ultra-rich? What if you are that top 2% we talked about earlier?
Well, this is where the math flips and where I actually have to offer some nuance to your hot potato analogy. If we are talking about a family with a $100 million estate, they are well over the $30 million threshold. Every dollar above $30 million is going to be taxed at a punishing 40% by the federal government when they die. In that scenario, handing over the hot potato while alive might be the smartest move they can make.
Wait, why? Why take the capital gains hit?
Because you gift the $2 million beach house now, completely removing it from your taxable estate. Yes, you are handing your heir a capital gains tax burden. The heir might eventually pay a 20% capital gains tax when they sell the house in the future. But a 20% capital gains tax on the growth is significantly better than the family paying a 40% estate tax on the total value of the asset if you had kept it in your estate. Wealth managers have to run complex spreadsheets comparing the future capital gains tax burden against the immediate estate tax burden to find the break-even point.
Okay, so navigating these tax traps, modeling cost basis versus estate taxes, dealing with irrevocable trusts, it is undeniably stressful and complex. But the sources we reviewed make something else very, very clear. The financial mechanics are only half the battle.
They really are.
The emotional and psychological toll on the heirs who receive this money, however tax efficiently it arrives, can be even more devastating than the tax bill itself. Which brings us to a phenomenon that wealth managers and therapists refer to as sudden wealth syndrome.
Sudden wealth syndrome, or SWS, is a recognized psychological condition. It describes the intense anxiety, guilt, identity crisis, and profound isolation that occurs when an individual receives a massive, rapid influx of wealth. It doesn't just happen with inheritances. We see it most commonly with lottery winners, people who receive massive legal settlements, or tech entrepreneurs who sell a startup overnight for $50 million.
The data surrounding this is actually heartbreaking. You grow up thinking that winning the lottery or inheriting millions will solve literally every problem you have. But a study out of Florida showed that lottery winners have a bankruptcy rate nearly twice as high as the general non-winning population.
Which sounds impossible, but it's true.
And there was a fascinating economic review of NFL players who were drafted in the late 90s and early 2000s. These are young men making millions of dollars a year in their early 20s, yet 15% of them filed for bankruptcy within 12 years of leaving the league.
The statistics are alarming, and they point to a broader truth. Broadly speaking, studies indicate that up to 46% of people struggling with severe, unmanageable debt have underlying mental health issues. Money doesn't cure the mind. In fact, if you aren't prepared for it, a sudden influx of wealth often fractures your mental state.
How does sudden wealth syndrome actually manifest? What does it look like in real life?
The psychology behind it is fascinating. It typically manifests in one of two extreme, polarized behavioral pathways. The first is reckless lifestyle inflation.
The stereotypical lottery winner behavior.
Exactly. The individual feels an intense, almost manic pressure to perform their new wealth. They feel they have to prove to the world that they belong in this new financial strata. They buy luxury cars, massive real estate they don't need, lavish vacations for their friends. They explode their fixed monthly operating costs, property taxes, insurance, maintenance, without understanding basic cash flow. They look rich, but they are bleeding cash rapidly, leading to rapid capital depletion.
And what's the second pathway?
The exact opposite. Decision paralysis. The individual is so terrified of losing the money or so overwhelmed by the sheer complexity of managing tax codes and investment portfolios that they just freeze. They hoard cash in low-yield checking accounts. They refuse to invest, they refuse to spend on themselves, and they let inflation slowly erode their purchasing power while living in a state of constant, paralyzing anxiety. They feel they are unworthy of the wealth and are terrified of making a mistake.
It also completely rewires their social lives, doesn't it? It has to change how people interact with you.
The social strain is often the most painful aspect of SWS. Relationships change overnight. Inheritors develop a deep, pervasive paranoia about why people suddenly want to be around them. Are you my friend, or are you looking for a loan to start a restaurant? Are you dating me, or for my trust fund? Furthermore, there is the survivor's guilt of having money when your peers are struggling to pay rent. Many inheritors isolate themselves entirely. They feel they can no longer relate to their old middle-class friends, but they also don't feel accepted by traditional old-money wealthy circles. They end up on a very lonely island.
I'm going to ask a blunt question because I know a lot of people listening are rolling their eyes right now.
Fair enough.
It is really hard for the average person who is struggling to pay for groceries and gas to feel sympathy for someone crying in a Ferrari because they just inherited $10 million. Why is it so hard for these people to just take the check, put the money in a broad market index fund, hire a CPA, and live quietly and happily off the dividends?
It is a totally fair question, and it's the logical response. But it fundamentally misunderstands human behavior. Wealth does not grant you immediate financial literacy. It doesn't grant you emotional intelligence or discipline. Wealth is simply an amplifier. It amplifies whatever behavioral flaws you already have.
So if you're bad with money and 50 grand a year.
Exactly. If you lack financial literacy, emotional regulation, or impulse control when you are making $50,000 a year, adding 2 zeros to your bank account just makes those flaws exponentially more expensive. If you use retail therapy to cope with mild depression at a middle-class income, you might buy too many shoes or a TV you don't need. If you do it with a $10 million inheritance, you buy a yacht you can't maintain. The scale of the mistakes grows, but the underlying psychological trigger is identical.
Wow. So how do professionals like wealth managers, attorneys, and specialized therapists actually treat sudden wealth syndrome? How do you prevent the yacht purchase?
The clinical consensus in the wealth management industry revolves around building immediate structure. First, they enforce a strict cooling off period. The advisor will mandate that the client makes no major purchases, doesn't quit their job, and makes no massive illiquid investments for at least 6 to 12 months after the wealth transfer. You let the emotional shock wear off.
Just hit pause on life.
Right. Second, you build a fiduciary firewall. You surround the heir with a team consisting of a CPA, a therapist who specializes in wealth psychology, and a fee-only wealth advisor to manage the complexity. This team acts as a buffer. If a friend asks the heir for a $100,000 loan, the heir can say, "I'd love to help, but my wealth management team has all my capital locked up in trusts and won't approve the distribution." It takes the emotional burden of saying no off the inheritor. And finally, the most effective treatment is preventative, prioritizing financial literacy before the transfer happens.
Which circles us perfectly back to the most practical, actionable takeaway from this entire deep dive. If you take nothing else away from all the trillions of dollars, the OBBBA tax codes, and the complex trust structures we discussed today, remember this one thing. Do not wait for the reading of a will to introduce your family to your wealth. If you are the wealth creator, initiate a formal family meeting now. The Cerulli data explicitly shows that 89% of high net worth advisors cite family meetings as the single most effective planning action you can take to ensure a smooth transfer.
It cannot be overstated. Transparency is the antidote to anxiety and sudden wealth syndrome. You need to sit your heirs down, outline your core values, explain the mechanics of your estate plan, and introduce them to your financial advisors while you are still alive. Demystify the wealth before it drops on them. When heirs understand the purpose of the wealth, the legal structures in place to protect it, and the responsibilities that come with managing it, they transition from being passive, anxious recipients to active, prepared stewards.
And for our listeners who are on the receiving end, if you know an inheritance is coming, or if you are already relying on parental support, it is time to have a very candid conversation with your family about the realities of debt, taxes, and expectations.
Absolutely.
As we wrap up, I want to leave you with a final, somewhat provocative thought to mull over. We mentioned earlier that a significant percentage of U.S. adults are currently relying on their parents for active financial support. The Great Wealth Transfer isn't some abstract macroeconomic event waiting to happen on a spreadsheet in 2048. It is happening every single day right now. If parental wealth is actively subsidizing the modern cost of living, if it's funding the down payments, paying off the student loans, covering the exorbitant childcare costs, we have to ask ourselves a very difficult question about the economy we live in. Are we actually building an economy based on merit, hard work, and innovation, or are we quietly shifting back to an economy based entirely on inherited stability, where your success is predetermined by the asset class your parents belong to?
It's the defining economic question of our era. If the prerequisite for a secure middle-class life is having parents who bought real estate in the 1990s, we are looking at a fundamental redesign of social mobility in this country.
When you look closely at the economy, you want to see a clear correlation. You want to see that hard work leads to a clear outcome. But right now, we are staring at muddy financial waters, and the current pulling underneath is driven almost entirely by the wealth of previous generations. Thank you for joining us on this deep dive into the data. Whether you're navigating the OBBBA, setting up a trust, or just trying to buy your first home, keep questioning the headlines, talk to your family, and we will catch you next time on Two and Compound.